Assalamu alaikum friends, welcome to day 6 of AFM 14 days revision crash course. The topic is WACC, the most important topic and a topic which you are going to get 110%. Okay, so you just cannot miss this. Okay, in order to emphasize the importance of this topic, okay, I would advise you that if you don't know how to calculate WACC, please do not go to AFM exam. It's that important. You are definitely going to fail AFM if you are not a pro in finding WACC. Okay, it's very important. So in day 5, I was explaining the dividend decision. Now we are going to carry forward with WACC. So here we are going to focus on past exam history, introduction to WACC, the cost of see to calculate WACC you need two things: cost of equity and cost of debt. So we are going to focus on them separately. Okay, cost of equity, also you can call it as KE. That's what it stands for. Okay, in order to study cost of equity, we need information about CAPM, capital asset pricing model. Okay, because through that you can derive cost of equity. In CAPM, the most important question is which beta factor should you use? Okay, you need to know the correct beta. Then comes the cost of debt, which is also KD. Then use of WACC as a discount rate. You can use that WACC. Why do we find WACC? There are so many purposes of finding WACC. Okay, one reason is it is used as a discount rate to discount your cash flow. You need it in your net present value. You need WACC in your valuation of company in mergers and acquisition. You need WACC in your reconstruction. So you need WACC in every part of your AFM syllabus. You just cannot escape it. It will come in one or the other way. Either it will come in net present value, either it definitely will come in a net present value if question is asked. If or you might get it in acquisition merger as a valuation of company, or it can come as under reconstruction, where you again have to find the value of the company after reconstruction, right? So WACC you cannot skip. But the principle, the way you calculate WACC is same. Once you know it, same, you just have to use it as a discount rate in all the other areas. That's it. It's not going to differ. Whether you use it for investment appraisal or acquisition and merger, whether reconstruction, the way you calculate WACC is not going to differ. That's the same. Okay. That so if you see the past exam history, what can you see? You can see that it has been repetitively asked, very frequently asked in question number 1, maybe 2 or 3 times in question number 3, but in question number 1. So now you know the importance of WACC. And question number 1 is a 50 marks question with 10 professional marks now. Okay, it has come every year. WACC, if WACC comes, cost of equity comes, with that comes cost of debt, then de-gearing, re-gearing will come, because to find WACC you have to de-gear, re-gear, asset beta, equity beta, you have to know all this. You have to be a pro by now at this. If you're not, please go back and do the questions. Enough of questions until you are a pro. Then bond valuation and credit ratings. There also you need WACC. Okay, so let's start with introduction to WACC. Okay, WACC is derived by finding cost of equity and cost of debt, and you just average them based on their market value. So in your exam formula sheet also the formula is given, but here still I will include it for you. This is the formula for WACC. Okay, you need not memorize it because formula is there, but you need to know how to apply it. What VE stands for, what VD stands for, what KE stands for, what KD stands for, you need to know that. Okay, so the first portion, the first bracket, it's value of equity, that is the market value of equity, divide by market value of equity plus market value of debt into KE. KE is cost of equity. Next, plus is the same thing, only in your numerator this time it is value of market value of debt into cost of debt, and 1 minus T, 1 minus tax. Why? Because debt has a tax advantage, right? Tax relief for the interest that you pay on debt. That's why 1 minus tax. Only for the cost of debt, not for the cost of equity. Okay. Now let's start with our cost of equity first, then we'll move on to cost of debt. There are three main methods of calculating cost of equity. Okay. Number one, capital asset pricing model. This is the formula, you know it. Risk free plus beta into market risk premium, that is RM minus RF. You will be given the risk free rate, you will be given the RM, you will be given the beta. Beta you have to work out. Okay. And then using this you can find. Second is, oh yeah, RM minus RF is also known as risk premium. So examiner often says market return or risk premium. If they say risk premium, remember risk free rate has already been deducted from your RM. You don't have to deduct it again. If they say market return is, let's say, 7%, risk free rate is 2%, then you have to deduct 7 minus 2. Okay. Second is we have dividend valuation model. Okay. So this is the formula, and formula is given also, but again it's here. For dividend valuation model, you need a dividend, you need the growth rate. Okay. So D0 is the dividend, G is the growth rate, plus P0. Third, Modigliani and the Miller's proposition 2. This is the formula. This is not always used. This is used in some places. Mostly this is used when you are given the adjusted present value calculation. Remember adjusted present value? There you use this mostly. Okay. So it is KEI. KEI means it is geared. Okay. You have to find the ungeared. This is geared. That's ungeared cost of equity. Plus 1 minus tax into KEI ungeared. So you are finding the geared cost of equity. Right? Divided by VD over V. Okay. So there are three methods in your exam. Okay. You have to be very careful which method you are using. Any one of these three you have to use. How do you know which method? Depends on the information given to you. You have to see, are you given the information for CAPM, like beta will be given, risk free rate will be given, risk premium will be given, then it is the first method, CAPM. If you are given dividend growth rate, then it is dividend valuation model. If you are given information about geared cost of equity, ungeared cost of equity, then it is the third method. Okay. I'm sorry for my voice, it's a little shaky because I told you of my health that I got cold. So okay, yeah, so all these formulas, the three are given on your exam formula sheet. Examiner will never tell you which method to use. So it is based on the information. You have to choose the correct formula. And remember, you have to be very careful in this, because if you choose the wrong, sometimes you will see some information are missing and you will start panicking. You're like, why am I not getting this information? Because it's not given. So you have to be very careful, because that will waste a lot of time. That will make you to make lots of mistakes later on. Okay. Now, question is, which beta factor should you use? Okay. If you have to calculate the current cost of equity, current beta factor. But life is not so easy. So is not AFM. So in AFM, current beta factor you cannot derive it easily. Easily they will not give you everything. They will not do spoon feeding. You have to do it. So what you have to do is you have to use a proxy beta. Proxy beta means a beta for a similar quoted company. Mind you, it's quoted company. Because for unquoted company, you will not get a beta. Okay, so you have to use a proxy beta of a similar quoted company to your company. They will give you in the exam a proxy beta, don't worry. Now, the beta value reflects two things. Any beta value reflects two things. You have to know it. Number one is business risk, number two is finance risk. Business risk means it depends on your operation, how risky your business is. Some businesses are more riskier than others. Finance risk, it is based on your gearing, how much debt you have, debt versus equity you have. Okay, there are two terms. So your asset beta, there are two beta, asset beta, equity beta. Asset beta is a measure of your business risk. It only measures your business risk. Equity beta measures your finance risk, but equity beta has both business risk in it, both business and finance, but it measures finance risk. That's why, because equity beta has both business and finance risk in that, your equity beta will always be greater than your asset beta. I repeat, your equity beta will always be more than your asset beta. That's a way to test. You can check in your exam all the time. Are you getting the equity beta more than asset beta or not? If it's the other way around, you are wrong. That's a sign, that's a hint for you. You can stop and redo your calculations. Okay, so just now I told. Asset beta is also known as ungeared beta because it does not have any gearing. Okay, you can say it's beta A. Equity is also known as geared beta. Equity E. Sorry, beta E. Okay. Now, in your exam, you have to de-gear the proxy equity beta. So you will be given an equity beta. What you have to do is, you have to de-gear. What is the meaning of de-gear? You have to use your gearing in that quarter. See, the equity beta that you are given, they have their own gearing, right? You have to put your gearing into that now. Remove their gearing, put your gearing. Okay, because it was based on the gearing of the quoted company. Now you have to reflect your gearing position. You understanding? That is re-gearing. De-gearing means you are removing their gearing portion. That means you're finding asset beta. From equity to, you're converting it into asset beta. Once you get asset beta, put your gearing in that and get the equity beta. You understand it? First asset beta, equity to asset, then again equity. You are given an equity beta, convert it into asset beta. That means remove the portion of gearing, their gearing. You are remaining with asset beta. Once you get that asset beta, put your gearing and get an equity beta. You understanding? So this process is known as de-gearing, re-gearing. De-gear to find asset beta, re-gear to find equity beta. And the formula is this. Single formula only. Same formula you have to use. But you have to just change a bit, because when you're finding equity beta, you can say this equation is for asset beta. Normally you can use, but for equity beta you have to change the equation a bit, because you have to make the equity beta the subject of the equation. And I'm sure you can do it fantastically. You can do it well. I don't have to teach you how to make this one the subject. That's maths. Okay, I'm assuming you know it. If you don't know, then make sure that you know. Okay, practice it. Like you take those things the other side of the equation and keep equity beta on one side, and division becomes multiplication, multiplication becomes division, like that. You know it. So here, asset beta is equals to value of equity divided by value of equity plus value of debt into 1 minus tax. Always 1 minus tax. It is stuck to that VD. Wherever debt is there, 1 minus tax also you will get. Okay, never forget, because students often forget 1 minus tax. Multiply by equity beta. Okay, first find asset beta, then again. Now that's over. Coming to cost of debt. This is easier. Trust me. Most of your marks are for cost of equity, because there lots of workings are required. De-gear, re-gear, use capital asset pricing model or dividend valuation model or Modigliani and Miller to find cost of equity. Cost of debt, on the other hand, it's easier, because there are not so many methods. You just have to simply deduct 1 minus tax. Okay. But if cost of debt is given, always assume it's pre-tax. That means before tax. You have to adjust it for tax. If it is post-tax, already it has been adjusted for tax, examiner will tell you. Okay, otherwise you have to always 1 minus tax. Okay, two methods. Number one method, dividend valuation model, yes, still can be used for cost of debt. But remember, there are two types of debt. If you have seen my lecture before on debt, you must know that there are two types of debt. Irredeemable debt, redeemable debt. Okay, irredeemable, redeemable. The way you calculate is different. So you have to make sure whether it's an irredeemable debt that is given or redeemable debt. Most of the time, based on the experience and based on what I have seen in the past paper, it is redeemable debt that is given. But sometimes you might be given a redeemable debt also. Okay, be careful. So if it's irredeemable, okay, 1 minus t into interest. I stands for interest. So 1 minus tax into interest divided by market value. And if it's a redeemable, you have to find the IRR of market value of that debt. Remember IRR? How to find IRR? Forgot? Can you recall? My first lecture was on net present value. There we talked about IRR, interpolation and all those things. You have to know that. Same here we are using it. IRR of how many? Post-tax interest redemption amount. Okay. It's like a loan. You can say a redeemable loan that you have to pay in 3 years' time. That is an example of redeemable debt. There you will be having interest which will be adjusted for tax. That's why it's post-tax interest. And redemption amount, the amount of the loan. Okay. Now, second is use of credit spread. What is credit spread? In credit spread, you'll be given a risk-free rate. With that, you have to add a credit spread. Now, to add a credit spread, you'll be given a table. See, credit spread is that one. Your credits are rated by a credit rating agency like AAA, AA, triple B. The triple A is the best. That means you have the lowest risk of default. If you are rated triple C, triple B, that means you have a high risk of default. You will not be able to pay back your debt. That is the meaning of it. It's like A. If you are getting A star, A in a class is always better than getting B and C, right? Same in credit rating. It works that way. Triple A is the best. Then a little better is double A. Then even little better is A. It's like that. That's how it works. So, but they will give you a time period, let's say 3 years, 5 years, and the rating. That for AAA for 3 years, this is the credit spread. And the credit spread are given in basis point. Okay, 50 basis point, 30 basis point, 40 basis point. So you have to add. When you add that basis point with the risk-free rate, remember to always divide whatever the number given to you in the table by 100. Let's say they give you 50 basis point. They write 50. You just cannot add 50 with your risk-free rate. You have to add 0.5. Why? 50 divided by 100. Always the basis point are divided by 100. So 50 divided by 100 is 0.5. So your credit spread is 0.5. So risk-free rate, let's say risk-free rate is 5%. 5 plus 0.5, not 5 plus 50. Okay, and then 1 minus tax because it's a debt. Now, credit spread can be calculated from an assessment of the company's profitability of default. You don't have to worry. Credit spread tables only will be given to you in the exam. Now, use of WACC as a discount rate. See, when you evaluate a project, no, this WACC is used as a cost of capital. You need a cost of capital. This WACC is used as a cost of capital. Okay, but the problem is you cannot use this WACC for all the projects because every project has different risk. So you have to adjust the WACC also accordingly. Okay, but existing WACC can be used as a discount rate if two things are there. Number one, if your business risk is same. Number two, if your finance risk is same. That means new project will not change your gearing. New project will not give you exposure to business risk. Then go ahead. Otherwise you have to adjust. And that will be discovered in my next video. That is for day 7. Okay, which is adjusted present value. That's why we come to adjusted present value, right? Thank you for watching. Don't forget to subscribe to my channel if you haven't, and please practice lots of questions on WACC. That's only going to be a value addition to you. That's it, nothing else. You might think it's a waste of time. I know WACC. Just doing 1 and 2 questions, you cannot decide that you are very good in WACC. No, WACC has different ways of appearing in an exam. Variety of ways. Okay, it is not like your risk management that it comes in a similar format all the time. It's not a standard question. It comes in variety of ways. You need to know all the ways. So practice as many questions. You will see every question has WACC. Every past paper has WACC. So do all the questions. Okay. So see you in the next video with adjusted present value. And till then, take care.